Hello and welcome to this session in which we will start a new auditing cycle, which is the investment cycle. Now, when we have investments, what do? We are taking some extra cash that we have, excess cash, and we are investing this cash in companies. We are buying stocks and bonds. But financial instruments, they have two umbrellas, either an equity investment or a debt investment. So when we say equity, what we mean is really stocks. Now, equity could take other forms of stocks. It could be a call option, a put option, some sort of a derivatives. That's fine. We're going to look at derivatives shortly as well. But when we say equity, we mean stock. Or you can invest in debt, which is, for our purposes, you could invest in bonds. So what's the difference between stocks and bonds? Stocks is when you become an owner. You are buying ownership in the company, especially when you buy common stock. Debt is when you lend your money. You're making a loan to another organization. You're buying their debt. Then we have derivatives instrument. It's a contract, so the investment is a contract where the value of that contract derive from other assets. Those could be options, puts, and straddles. Usually it's equity, but you could also buy derivatives against bond. But usually it's against equity. And what are options and puts? It's basically you have the right to buy the stock at a certain price, or you have the right to sell the stock at a certain price. So that right is derived from the changes of the stock. So the first thing I want you to know is just what are we looking at? Financial instruments, could be stocks, could be bonds. We could have derivatives. Again, those are more complex instruments, but I want you to know that they exist. Now, the first thing we are going to do, we're going to look at the investment classification. When management makes this investment, when they take this cash and they buy stocks, well, how do they classify this investment? Then we're going to talk about the fair value and talk about, in general, what risks are related to these investments. How is inherent risk determined? How do we set performance materiality for financial instruments? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
So the first thing we have to determine is management intent. What's management intent? Are they buying those securities for one category? Could be trading purposes. So A is trading securities. So they bought this investment and they want to sell it. They want to trade it. They want to flip it. That's trading securities. Well, that's going to increase the risk because you're going to have more of these trades. And because the motivation is profit or loss, you have to be very careful auditing these companies. Available for sale securities, let's call it category B. You buy the stock. You don't plan to trade it, but also you don't plan to hold it forever. So it's available for sale. So it may be sold if the price is right, but we're not actively trading this. Or the third category, which is called held to maturity. Well, the only investment, the financial instrument that you could classify as held to maturity, which is classification C. There's no such thing as A, B, and C. I'm just telling you it's an investment, but you can classify it under three categories. The only classification is bonds, because stocks don't mature. Held to maturity means the investment will mature. Stocks don't mature. Stocks go forever unless the company obviously go out of business. Bonds, they have actually a maturity date, an expiration date. So the only investment you can say I have this as held to maturity is for bonds. And those are easy, boring to audit. Fair value. Fair value is important because when you have an investment, you have to determine how much should you report this investment. So you have to understand, how do we come up with fair value? Investments are categorized by how easily their value can be determined. Because fair value is what amount, this deals with valuation and accuracy. What dollar amount do you put in this investment? Well, we're going to have three levels. Level 1 prices are quoted prices in the open market. like publicly traded stocks like Apple, Amazon. You have 1,000 shares of Apple, 500 shares of Amazon. Those are the easiest type of investment to find the fair value for. So if you have them, that's easy. You can look up the price on the Wall Street Journal. You could look up the price at CNBC or Amazon and find the price. The second level fair value is prices based on similar asset with no direct quote, because you could look up exactly how much Apple is traded at on CNBC or at any point in time, or Finance Yahoo. Level 2, you don't have quoted prices. So how do you determine how much is your investment worth? You would look at similar assets. So let's assume two companies. You invest in a company that is private. Private means you don't know the investment value because it does not have public prices. You could compare this, you can compare your company to a similar company that's public of similar size, similar performance. To give you a simpler example, let's assume you want to value a building. You don't know, there is no active market for your building, but 2 streets down the road, a similar building was sold for 10 million. Very similar to yours, very size, location is practically the same. Then you would say my building is worth 10 million. So there is no direct quote, but similar asset. And level 3 is the hardest to determine and the riskiest for the auditor to deal with. And that is model and assumptions made by the company. So the company has this private shares, but they don't know how much to value them. So what they do, they determine their own value. How? They would look at the future cash flow of this company, and they would say, based on the future cash flow, the stock price should be such and such. So this is one of the risks that we have to take when determining the fair value. Level 1, there's no risk. Level 2, less risk. Level 2 is a little bit more risk, not less risk, more risk. And level 3 is the riskiest type of investment that you are auditing, because you have to examine the assumptions made by management. If they say the cash flow is 50,000, well, you have to know how did they come up with that. Then you have to investigate whether their assumptions are reasonable. Another risk that we have to deal with when we are dealing with investment is the business risk associated with those instruments. Like what? We have to know how much money is invested. Are they investing 10K? Are they invested 100K? Or are they invested 10 million? How much money is invested in, how much cash is invested, how much cash is tied up? That's the significance of the investment. And when we look at significance, obviously we look relative to others. So even if they have 10 million and they have 1 billion in asset, this becomes insignificant. But if they have 10 million and they only have 50 million in assets, then that's a large proportion of their asset is tied up in investment. So the significance of the investment matters. How much money, how much cash is tied up relative to other assets. That's one factor. The other factor is the aggressiveness of the investment itself, because not all investments are the same. Certain investments are riskier, more aggressive than others. Well, let's start with not aggressive investments. What could be not aggressive? We're looking at conservative investments. Like what? Put your money in the bank. If you have your money in the bank, certificate of deposit, you are taking no risk whatsoever. This is a conservative investment and the risk is practically zero as long as it's less than 250,000. Or you can give your money to the US government, buy treasury bill. That's also a conservative investment. Or you can buy AAA bonds that are rated at the highest level, conservative investment. Or you can buy aggressive investments like option contract, puts, betting on price declining of the stock, complex derivatives. Those are complex derivatives and those are aggressive investments. Your risk goes up. The more complicated or aggressive the investment is, the harder it gets to the auditor, because they have to be very careful. It's not a clear cut. There might be some formulas, computation, assumptions that they have to examine very, very carefully. So the size of the investment, its aggressiveness matter. And what else matters? The industry that you are investing in. Are you invested in retail? Are you invested in high tech? Are you invested in pharmaceutical companies? Are you investing in the software industry? So that also matters. Now, how do we set materiality and inherent risk? Materiality for investments very similar to cash, not the same. It should be set low, especially when you have publicly traded companies. But what's materiality? Performance materiality is how much of an error you can accept before you say the account is not fairly stated. Now, zero means you don't accept any errors. And if you want zero, it's going to be very hard to audit unless it's easy to audit. For example, for cash, we set materiality very low, practically zero, because we should know how much cash we have. Investment should be the same as long as we're not dealing with level 3 or level 2. So when it comes to financial instrument, this depends on the size of the investment. Also, if the size of the investment is large, we have to be very careful, because a small mistake, a 3-4% mistake in a large account could be substantial. And how easily the investment can be audited. Most investments, if they are being held with a broker, it means those investments are invested in publicly traded companies. Very easy. Why? Because the broker will give you all the confirmation, what they sold, what they bought, and if the prices are publicly traded, they will give you the price as well. Therefore, materiality should be very low, close to zero. So publicly traded companies are simple to check. Why? Because the prices are known. There's no reason to guess, no reason to work any formulas. So private companies, on the other hand, require more scrutiny. Why? Because you need to make certain assumptions. So that's about materiality. It should be low, especially if you have publicly traded companies. It should be technically zero, theoretically. Just like very similar to cash. How about inherent risk? Inherent risk for investments depend on many things. One is the complexity of the investment. Again, not all investments are the same. Are you dealing with simple stocks, or are you dealing with exotic derivatives? If you have exotic derivatives that you cannot easily understand, then your inherent risk goes up, because internal control can't do anything about protecting you. Two, what's the fair value of these investments? Is it level 1, which is pretty straightforward, no inherent risk whatsoever? Is it level 2, more inherent risk? Or is it level 3, the most inherent risk? What's management intent? Are they holding these stocks for trading, hedging, or holding to maturity? Holding to maturity, nothing to worry about. Trading, it's a lot of work. Hedging is, why are they hedging? Are they hedging truly to hedge, or are they gambling? Management experience. Now, they have this investment. They have this money tied up in these investments. But how familiar are they? How familiar are they with managing those investments? Do they have experience, or they don't have any experience with it? Also, external influences on these investments. Is there a credit risk or interest rate risk? Are these investments subject to an interest rate risk? Why? Because if they're subject to interest rate risk, your inherent risk is high. You have no control over that. Or what's a credit risk? Credit risk means the other party don't pay the money because they defaulted. There's nothing you can do. If you lend your money, it doesn't matter how careful you are, and if the company don't pay you, there's nothing you can do. There's a credit risk. The other company failed to make their payment because they cannot. Once again, I want to focus a little bit on management investment goal, because that matters. So it all boils down to, what's the management intent? If it's trading, it's more complex because you have speculation risk involved. If it's hedging could be either or. I'll give you an example shortly what I mean by either or it could be held to maturity, which is safe and boring. But hedging, it could be to protect yourself, or it could be for gambling. The best way to illustrate hedging is show you an example. Let's assume Starbucks, although this is not a realistic example because Starbucks, they don't buy their beans. I believe they produce them. They have their own places. But beside the point, it doesn't matter. Let's assume the company let's take out Starbucks, and it's a coffee shop. They want to buy coffee beans. But the price of coffee beans, just like any commodity, it fluctuates. It goes up and it goes down. So what would this coffee shop do is they will buy an option to buy the beans at a fixed price. For example, they would say, we're willing to pay $100 per ton. And on the other hand, on the other side of this contract, there is someone who's willing to sell them the coffee beans for $100 for 6 months. Therefore, they lock their price. Well, obviously, they have to pay a fee, but they bought this contract, this hedging contract, to protect themselves. If prices go up, if the prices go up to 150, they're going to be very happy because they can buy it at 100. If the prices go down to 75, they lost the fee and they will buy it at 75. But this is what hedging is. They don't have to worry about anything else. Versus you have a trader, someone who is trading coffee beans, and remember that fluctuate. and they're trying to make money on the price fluctuation. That becomes speculation, and it's risky. So in this session, we looked at equity investments, debt investments, the different classification, the risk associated with these classification, setting materiality and inherent risk for the company. Now let's take a look at this multiple choice question from farhatlectures.com. Which of the following statement is correct regarding business risk and financial instrument? Risks will be higher for companies investing in less liquid securities. What is less liquid securities? Less liquid securities means the securities are not bought and sold very often. Is this a risky investment? Yes. If it's less liquid means there's no active market. No active market increase the risk. So A is there, but all of them have A. Therefore, we cannot eliminate any answer choices. 2. Financial services firms are usually exposed to greater risk. Generally speaking, yes, usually they are, because financial services, they are exposed to the financial market and they invest in investments all the time. Therefore, they are exposed to all sorts of risk. I would say 2 is correct. So we have 2 here and 2 here. And basically 1 is out. And yeah, so we keep 2. We keep 2. 1, we said no, 1 is in. So 1 is in. Okay, we're going to see now. Okay, so we're going to see if it's 3 is correct or not. If 3 is correct, then we're going to go with D, 1, 2, and 3. If not, we're going to go with 1 and 2. 3. Business risk associated with financial instrument are the same regardless of the significance of the company investing activities. No. Financial instrument risk is not the same regardless of its significance. The higher the dollar amount, the more the risk. And the lower the dollar amount, usually the lower the risk. Therefore, 3 is incorrect. So we could take out C. And basically D should be 1, 2, and 3. Take it out. So what's left is B. 1 and 2 are correct. What should you do now? You want to go to Farhat Lectures. Look at additional resources, multiple choice, true, false, AI CPA questions. Whether you are an accounting student or a CPA exam candidate, invest in yourself. That's the best investment you can make. Good luck, study hard, and of course, stay safe.